Good afternoon. This is Robert Rayburn at Life Pro Asset Management. It is the first day of the second quarter, April 1st of 2024. And it certainly feels like that first quarter went through quite rapidly. Now, the good news is that results were pretty good, whether you're looking at the market as a whole or you're looking at various strategies that we manage for our clients. Certainly, we're happy with the way the first quarter of the year panned out, but there's three more quarters left to go and countless quarters to go before clients reach their goals. So we want to make sure that, yes, we're staying focused on the long-term picture, but also in the short term, understanding what adjustments can we be making in the portfolios to continue that momentum, to protect some of those gains, and certainly learn from what happened back in 2022 with the market and just continue to improve our process as asset managers. So big theme here going into Q2 is that market breadth remains strong. Certain parts of the market look tired and weakening, but in a bull market, and we'll go through this more in the presentation, bull markets have a habit of recycling through sectors, right? So as one sector gets tired, another sector starts to wake up, right? So that's a big theme around bull markets. As one area goes to sleep, and others waking up, versus bull markets where everyone sort of falls asleep at the same time. So with that said, let's go ahead and start the presentation. Now, the big question that I think a lot of our investors want to know, and a lot of investors throughout the country want to know, is that will the bull market continue? We got an election coming up. We have volatility overseas, whether that's the continued wars in the Ukraine or volatility with China. So many things that could potentially derail the bull market. So will that bull market continue? So three big things that we want to focus on underneath that is navigating an overbought but healthy market, right? So the market looks healthy. Short term, it is a little overbought. So how do you navigate that? Number two, technology stocks certainly look tired. Now, we've walked through countless charts to show that. Yes, NVIDIA continues to act well, but underneath that NVIDIA mirage, more and more technology stocks breaking down. What does that mean for you? What does that mean for the market? How should we approach asset allocation as a result of that? It is the largest sector on the S&P 500. And lastly, momentum appears to be accelerating across the value space in terms of value stocks relative to growth stocks. Now, a bull market dynamic. We talked a little bit about this just a minute ago, but the real theme here, and this is sort of a good illustration to think about all of this, is that a sector heats up, and the first sector coming off the bottom was technology. We don't have to give too many examples here, but you could look at NVIDIA, you could look at Meta, Amazon, Facebook, you name it, right? Well, Facebook and Meta are the same company, but regardless, you can look at countless stocks to show that sort of how tech was that first sector that bounced. It was also the most oversold. Then that sector becomes overbought, right? We've seen those parabolic charts with certain semiconductor stocks, certain software stocks. At that point, you want to be careful, right? Now, in a bear market that has narrow breadth, that would be a flag for concern to have any exposure anywhere. But in a bull market, something happens, and that is that other sectors happen to pick up the torch. And that's why market breadth is so important as part of our framework. We want to understand, as we're going into a bull market and risky pockets of the market are rallying, are other parts of the market doing well too? Are they participating so that if one area starts to tail off, another area can pick up the baton and continue to advance the overall market? It's really, really, really important. And so that lends into how we look at risk management. In a bull market, your biggest concern is a correction risk, right? Which in many cases, it's a risk we're willing to bear. Because corrections are so hard to time. So if a correction defined as a 10% drop in the market, the first 5%, you don't know if it's just a 2 or 3 day phenomenon or if it's a correction. And at 10%, you don't know if it's going to go down more or if we're immediately going to bounce. So it's very hard to time those corrections because corrections tend to be short but violent. And in a bull market, you'll enter into a correction in an overbought condition typically, but the backdrop of that market is where we see rising and strong market breadth, right? Where most stocks and sectors are participating in that rally. The typical blueprint for us is that we would want to add exposure during those dips. A bear market, on the other hand, is where you have an overbought condition, but in a market of declining or weakening breadth. In other words, breadth is narrowing. As the market goes up, fewer and fewer stocks are participating in that rally. That's the flip. That's the flip side of our game plan for a bull market, where we would use rallies to reduce market exposure. So let's look at what is the breadth of the S&P 500 doing right now. So we look at the percentage of stocks above that 200-day moving average. They continue to rise. We're at 85%. Now, is that overbought? Yes, it's overbought, right? That's fine, though. Remember what we said. Bull markets tend to spend most of their life in an overbought condition. So if you're constantly worried about the market being overbought, you're going to miss out on most of the rally. And from 2009 to 2022, that was a 13-year rally. So it can have consequences if you're constantly on edge over an overbought condition. What we want to be careful of course, is that you go into a rising market like you saw here in late 21, early 22, and breadth is doing this. It's falling. In other words, fewer and fewer stocks are holding up the rest of the market because eventually those stocks succumb to gravity. Eventually, the entire market folds in as those last market leaders eventually sell off. What we see here is the complete opposite picture of what we saw in late 21, early 22. Yes, the market's overbought. This has been a strong rally, but breadth is really strong. 85% of stocks are trading above that 200-day moving average. So we have a strong foundation of support that if tech or any other sector comes off, another sector can swing into its place. The other thing I would like to note is that the number of strategists that believe the market will end up higher from April 1st is quite minimal. The average strategist on Wall Street believes that the market will fall 5% from here between now and the end of the year. That's actually a bullish sign in our opinion. When everyone's bullish, that's when we kind of want to be more careful. When everyone's skeptical or bearish, we kind of want to press the gas a little bit, or we want to maintain our risk exposures. So I think that's actually a good thing that you're seeing skepticism across Wall Street. We're not at that point yet where everyone is all in. And this is where we see a strong breadth right now. So when we look at the percentage of advancing declining stocks, 7-1. When we look at yesterday, or not yesterday, because I'm recording this on Friday, but on Thursday, we hit that big market rally. That was a 7-1 advanced decline ratio. Again, really, really good participation on those daily breakouts in the market. When we look at the equal weight S&P 500, again, very indications of very strong breadth, hitting that 52-week high, breaking out of this cup and handle formation. That Thursday rally was marked by a 2 standard deviation rally on an individual day. So again, strong momentum, strong breadth. Strong momentum, strong breadth. Those are two confident signs that a bull market remains healthy. Is it a guarantee? Of course not, right? Anything can happen, but that's the blueprint that we use. So carrying that tech torch, what we saw last year is that tech was the leader. That led to a lot of the Magnificent Seven rallying, etc. What we see now is narrowing breadth. So our job is to say, okay, like what's going to be the next sector that carries the torch? And for those of you who've paid attention to our weekly updates, you know, energy has been a core pillar of what we believe will work, not just short term, but longer term. What we're seeing there is expanding breadth and is now the current leader of the market. So when we look at Q1, energy was the #1 performing sector. At some point, and we're not there yet, and we'll go through why we think that's the case, energy will need to rest. So then we'll have to ask ourselves and do the work now to try and determine that what are the other areas that could potentially carry the torch? Is it the emerging markets? Is it the banks? Is it tech? Will tech have sold off enough to resume leadership? So those are the questions we want to ask today as we prepare for tomorrow. But we can see those symptoms in technology. Apple is underperforming the S&P 500 by its widest margin since October of 2013. Does that mean it's oversold? Not really, because obviously from this point, Apple was going through a major bull market in itself. That company was going through a transformative period. I think we're in a bit of a different situation right now where there really is a lack of iPhone or iPhone-like catalysts in the pipeline. The headset they recently released at a $3,000 price point, not really the type of consumer device that would gain that mass adoption, such as the iPhone. Certainly lagging on the artificial intelligence side. You're not seeing much of an offering. I know there's a developers conference in June. We'll see what they have to offer then. And then the antitrust litigation. So people ask us a lot about that antitrust litigation. Our thoughts are that it's important, but not for the reasons that people may think. Maybe they break up the company. I doubt it. I don't think there's a case there. Their primary case is that the company is too big. We think it's too big from an investor standpoint. At 3 trillion, or where it was at 3 trillion, how much upside is there to 3 trillion market cap? What it does do, though, is it sort of prevents the company from going out there and making strategic acquisitions that a lot of big companies do to get into new areas. Because if you have a player that's going through antitrust litigation, very hard to get a deal approved. And I think that's the more important point of the antitrust lawsuit that the government introduced. At a sector level here, we see technology stocks as the percentage of technology stocks trading above that 50-day moving average continues to decline. Remember what we saw with the S&P 500 as a whole. That continued to rise and break out. Complete opposite type of situation. So as markets push to new highs, that breadth across technology is narrowing. So the question is, pertinent question, where's that money going? Well, it's going into energy, quite frankly. That's where we're seeing, this is the percentage of stocks at 3-month highs. Look at that, 78%. Look at that strong upswing versus what are we seeing in technology? A downswing, right? So from a downswing to an upswing, very symptomatic of a healthy bull market, where you go from the tired sector here in technology to the sector that's waking up, energy. And it's 78% of stocks trading at that 3-month high. Good momentum thrust, followed or backed up by strong breadth. Most stocks participating in that rally within energy. We're seeing that in the oil prices as well. Obviously, a big component of what supports energy stocks. You need oil to be going the right way. But honestly, that oil chart, it's been kind of trading in a range of 70 to 80. And at 70 to 80, these companies make a lot of money. Very high free cash flow yields, very discounted valuations, a big part of why we love oil so much. Of course, seasonality is on our side right now. Historically, oil tends to rally quite significantly between the months of February and early July. Why? The driving season. You get into Memorial Day, you get into the 4th of July. Americans simply drive more, and we own a lot of cars. So it's simple math. So that leadership rotation, we do believe that we're sort of in the early signs there that we're rotating away from growth and into value or other areas of what we call orphaned growth. So if we look at Chinese stocks, those are former growth leaders that now trade at very deeply discounted valuations that we call the new value, right? So that growth is still there, but the prices are much lower. So we call that orphan growth. Materials, banks, energy stocks, all part of that value trade that we think will become leadership. In some cases, like energy, has already become leadership in 2024. So in summary, let's embrace that rotation. Yes, let's also embrace the market. The market breadth is strong, but overbought. So there is always a risk of a correction. We want to be very clear about that. So how do we offset the risk of trying to time a correction versus trying to create returns for clients? Let's focus on the areas that are not as exposed to a correction. In this case, let's steer away from these consumer finance names. Let's steer away from technology. Let's steer away from consumer electronics and try to focus a little bit more on those value areas such as China or energy, commodities, emerging markets, etc. The banks. Technology, as I said, does look tired. Energy, waking up. One area, tired. Other one, waking up. They don't have to wake up and go to sleep at the same time, right? So we want to be really careful and distinguishing one asset class from the other. And lastly, we want to favor value in small caps over growth. I saw a chart the other day. Small cap ownership is near all-time record lows relative to the S&P 500. So small caps may very well be in a position for acceleration here as well. So that's what we got for you. I hope everyone had a fantastic, safe, and fun Easter long weekend. Hope everyone has a great week. I know it's spring break for many of you. So that's the case. Please don't spend too much time on these types of videos. But if you have any questions, 888-543-3776, or feel free to reach out to your advisor. Thank you again and have a fantastic week.